Hey, what's up guys? John here. BlackRock, the world's largest asset manager with $10 trillion in assets under management, just said something that we all need to pay close attention to. So whether you are a real estate investor, investing in residential or commercial, or maybe you just have an auto loan, maybe you have a credit card, maybe you have some type of outside debt, what they just said, what Jerome Powell is saying, is something that we all need to pay close attention to. In this video, I'm going to break down what's going on because I believe we're stepping into a once-in-a-lifetime opportunity to make an absolute fortune. And I believe that we are in the greatest wealth transfer of all time, and we are in the biggest economic rug pull, the biggest setup that we've ever been in. And it's going to unfold in 2023 and 2024. We all need to be prepared for it. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on. And today's video is sponsored by my company, GreatCreditFast.com. GreatCreditFast.com. If you have situations in your credit report, maybe it's charge-offs, late payments, medical bills, collections, repossessions, you have something on your report that's holding your score down. It's going to make life a lot harder to get financing. If you want to invest in distressed real estate and you have bad credit, good luck. It's not going to happen. Go to GreatCreditFast.com or give us a call at 561-430-5900. We'd love to give you a free consultation. Take a look at this. So BlackRock said the Federal Reserve, the fund's Fed rate could hit 6%, right? So 6%. I asked ChatGPT, if that did happen, what would mortgage rates hypothetically be, right? Would they be hypothetically? And they said right around 8 to 9%. However, it's going to be dependent on factors such as inflation, demand for mortgage-backed securities, global economic conditions. To me, that means as inflation kind of moves in this direction of being more and more and more stubborn, I believe we're not going to beat inflation. I think inflation is just going to get harder and harder. What is that going to do? It's going to likely push interest rates even higher. So we could see 9, 10% interest rates. But something fascinating is happening right now in commercial real estate. Now, a lot of people are renting in commercial properties, and this could have a really big impact on you. So commercial properties means 5 units or more. So if you're in a apartment building and there's more than 5 units, that's commercial. And so 1 out of 3 commercial mortgages in America is floating rate debt, meaning that their interest rate went from 3%, 3.5%, 4% a year or so ago to now 6, 7%, and now it could go to 8, 9, 10%. This is an absolute nightmare for these landlords, and on the back of that, you have a situation, according to this data, nearly 25% of renters have claimed as of recently, this is 2022, that they're behind on monthly rent. Now I've seen numbers, such as 18%, I've seen numbers 20%, but regardless, 1 out of 4, 1 out of 5 renters not paying rent. You have insurance costs going up, property taxes going up. I mean, that's bad news to these commercial property owners. And what I think is going to happen is we're going to just start to see the dominoes fall in commercial real estate. That's why you're looking at BlackRock, Blackstone, KKR, the biggest real estate funds. They were halting withdrawals. They weren't letting investors get their money out. Now, I know a lot of people were, raising money to invest in real estate, commercial real estate, last couple of years, buying deals at 3, 4% returns. How are these operators going to make good on their, commitments to their investors, paying them a monthly dividend if their cost to borrow money is skyrocketing, if vacancies are continuing to rise, if they're collecting less money and their insurance and property taxes are going up? They're going to have a big problem. So I think a lot of the big syndicators could be stepping into a very bad situation in the next year or so, especially if BlackRock is correct. But according to Jerome Powell is saying very similar things. Jerome Powell said here is 5.5 to 5.75%. That was their target. That was yesterday. So, I mean, it's not far off from what BlackRock is saying. However, Jerome Powell said employers added 517,000 jobs in January, a surge that shocked economists who were anticipating hiring to slow. Inflation declined late last year, stalled in January. The 12-month inflation rate, excluded volatile food and energy items, was 4.7%, up from 4.6% in December, as measured by the Commerce Department's Personal Consumption Expenditures Price Index. And so the next day, today, it says U.S. job openings dropped to 10.8 million, but are still too high. They're still too high. And you start to look at what Jerome Powell said. He said, Fed Chair Powell said interest rates are likely to be higher than anticipated. But he also says here that we're talking the only measure we have to bring inflation down. Powell said we're working to get people better off, not just working away from their jobs. He goes to say restoring price stability will likely require that we maintain restrictive stance on monetary policy for some time. The historical record cautions strongly against prematurely loosening policies. We will stay the course until the job is done. So they're going in this direction. They're not going to pivot in the short term. At least that's what it seems like. And so as we start to move in this direction, they think that they're going to bring inflation to 2%, 3%. It's not going to happen. Not as energy prices continue to rise. We're going to start to see this situation. We're basically, this truck is getting driven into a wall. This economy is in very, very big trouble. And Jerome Powell, this current strategy, it's going to be a very, very bad one for real estate investors that are extremely leveraged. Mainly because they bought into the story the last year or two that inflation and the dollar being eroded is the biggest problem. No, the biggest problem was that we were all set up. The economy was set up for the greatest rug pull of all time. That's the problem. It wasn't inflation. Sure, inflation was bad, but they pushed everyone into investing into overpriced assets after they stimulated the economy with QE and 0% interest rates. I mean, it was just horrible policy decisions. It was a horrible situation for Americans. And look at what this would do, though. For just out of a context, $1 million property. Let's say $1 million property. It seemed like everybody was buying $1 million property, a couple of years ago, or like 18 months ago. $1 million property, $3,800 a month. $3,800 a month at a 3% mortgage. That same mortgage, literally double, right? Double at 9%. So how is this not going to have a massive impact on residential real estate, on commercial real estate? It's going to. There's no doubt about it. Even like in Los Angeles, for example, there's communities that many people would say, not really a safe, nice neighborhood. Homes in those neighborhoods are selling for $850, $900, $950 grand, $1 million, right? So to buy a house in one of those neighborhoods where you don't really feel safe walking your kids at night, it's like there's pit bulls on the street. It's kind of like you're just a little scared to go out there, especially let your kids play in the street or anything like that, or play in the neighborhood or walk across the street or any of that stuff. You have to make 18 to 20 grand a month to be able to live in one of those neighborhoods. Right, you have to make 3 times. The rule of thumb is usually 3 times your mortgage. Right, so $6,500. You're talking 19 grand, 20 grand a month in income. Right, no one's going to pay 20 grand a month in income to live in one of those neighborhoods. Point blank, they're just not. Anyone making 20 grand a month is going to say, you know what, I have options. Right, I have options. But 2 years ago, $3,800, you're like, okay, I got a school teacher, she's making $6 grand a month. I got her husband is making another $6 grand, they're making 12. Maybe they can afford this. They can afford that. $4 grand a month, maybe they got it. Maybe they have 300 grand in savings from their, throughout their history of their jobs, or maybe their 401ks, stocks, whatever they saved up. Maybe they have that 300 grand down. Even if they don't, let's say that they have 20% down. 300 is a lot, right? So $4,200. Even that would still be within striking distance. If they're making $12,000 a month, it's not far off. We're going to start to see a massive repricing of assets in residential and commercial. As I've mentioned before, I think what we're going to start to see is so much rental inventory hit the market that we just see rents plummet in expensive markets because they're not going to have the equity in their residential deals that they put 3%, 5%, 10% down. And they're not going to have equity, and so what are they going to do? They're going to rent their houses out based on their cost and based on the comps in the neighborhood. If comps in the neighborhood are softening, they're just going to try to break even. They just want to be able to hold on to the property and not lose their house. That's what we're going to start to see. They're setting everyone up for this. It's interesting. They're setting everyone up saying, you know what, rents are only going to go up 18%, 20% in a year. You got to invest money because you could borrow money at 3%. Inflation, the dollar's getting crushed. Why not borrow money at 3%, invest it into an asset that's going to continue to skyrocket in value? You could fix it up. You could even increase the rents even more. You could pull your money out of the deal so you have no risk in the deal. You own this commercial property and you just get rich. Everyone's like, yeah, that sounds awesome. Until it's not, right? Until defaults start to skyrocket, rents start to soften, and the cost to borrow money doubles or even triples in this potential situation. But this is fascinating to me because, look at this guy, Michael Gigliotti, co-head brokerage of firm JLL's New York City office. Property owners are now faced with limited options when it comes to expiring interest rate caps. Unlike the height of the pandemic, when lenders would often agree to loan extensions, all possible paths are pricey. Whether it's purchasing a new cap, paying down the loan, or refining at an elevated borrowing cost, the last option might spur sponsors to sell at a loss. So to buy an interest rate cap on a $25 million deal or $25 million loan, $569,000. Last year was about $100,000, right? So it went up about 500%, 450%. That's nuts inside of a year. That number is likely only going to continue to rise as rates continue to rise. But on another deal, on a smaller deal, let's say a $10 million deal, $3 million down, at a 3%, your monthly cost $26,000 a month, right? $26,000 a month. But if you have on a $10 million deal, maybe you have, 50 tenants, 40 tenants, and they're all paying you $1,500, $1,800. You can make those numbers work. But if you were to refinance or finance them at 9%, the potential interest rate, it'd be $45,190 a month. A month. So what options do they have? The value of the building probably dropped by 50% if the cost to borrow debt tripled. So that would mean that they'd have a $5 million deal, hypothetically, where they owe $7 million on it. So they're upside down by 50% on their deal, right? What are their investors going to do? Are they going to spend, $300,000 to get a lock for a year or 2 years to hopefully weather a storm? Or are they going to start walking away? I think we're going to start to see a lot of these people walk away. Now, these syndicators, they made out like bandits because they were like, yeah, you got to buy this deal, $10 million deal. We're going to fix it up. We're going to raise the rents. This is going to be a $15 million deal, so you can get all your money out, still get cash flow. It's going to be an awesome situation. But it was only an awesome situation for the syndicator, because the syndicator's making a 2% fee right on the purchase, so they make $200,000 commission right on the deal, right on the closing, plus they get management fees, plus they get paid out on a refi, plus when they sell the deal, if it works out, they get another fee. So yeah, for sure, it's great for the syndicator. But when you start to look at all these people that invested in all these REITs, I think a lot of them are probably going to get hurt. But if you are an investor and you're like, hey, I want to buy real estate, the time to buy is when everybody wants to sell. The time to sell is when everybody wants to buy. I think we're stepping into a time that many people are going to say it's a horrible time to buy, but I think it's going to be an incredible time to buy. I don't think we're here yet, not by any stretch of the imagination. I still think 80 or 90% of the economy or the investors still think that, we're going to see a pivot. Once that hopium fades away and there's more fear and people are like, oh, I'm screwed. Like I'm absolutely in big, big trouble. That's probably, you're going to probably want to wait a little bit longer than that until there's real panic and blood in the street. And then you're going to start to see some real investing opportunities. But you want to be prepared. If I were you, I would try to network with people around you, try to find other smart and savvy investors, or find people that are on the same page and wavelength as you. Get some cash together, start to kind of build up some type of financial ammunition. And if you're going to buy a residential deal, maybe you're renting right now and you want to buy a 2-unit or a 4-unit deal, that's going to be a great opportunity. I think we're going to see a lot of distress there and some great situations, because if you borrow money at 8 or 9% to buy one of those deals, the value of those deals are probably going to drop significantly. And so if you can buy something at a significant discount to replacement value, meaning if the land's worth $100,000 and it costs $300,000 to build it, $400,000 cost to buy it brand new, and you can buy it, used at say $250,000, $300,000, you finance it at 9%, and then you could fix it up a little bit. And then if rates do come down in 2 years or 3 years, you could refinance. The only thing that matters is the price you pay. I always said that it's the price you pay that makes the deal. It's not the interest rate that you lock in. The interest rate, is an added bonus, but you're not buying the rate, you're buying the deal. And so if you can buy a great deal, then I would suggest doing it. But I think we're going to start to see these incredible deals coming very, very soon. But you want to have great credit. If you need help, we'd love to help you at GreatCreditFast.com. That's GreatCreditFast.com. Give us a call at 561-430-5900 for a free consultation. Subscribe here, and subscribe also on Instagram. Up in the banner, it's a hyperlink. You can just click it and subscribe. Catch you guys in the next video.